nervousness around the India-Pakistan border issue, which was keeping sentiment depressed, start to moderate a little bit as it's not gone away, it's still a topical conversation, but as days roll on, the market starts to feel a little more comfortable here. Small cap index is up 1/3%. I think you've got the mid cap index, which is also starting a little higher. And actually on the screen, it's all green. The Nifty heat map should come up on your screen next, and it'll give you a quick sense of how we are likely to start. It's all mostly in the green. Some actually 14, 15 names are in the red as well. I can see Eternal on one end and Adani Ports on the other end. Surabhi.
On Eternal, the price cuts that some of the brokers are talking about, or rather the earnings expectations cut, Motilal Oswal's estimates have been reduced by 52% for FY26 and some 20-odd% by FY27. So given by that stretch, it's not bad. The stock is seeing buying. It opened gap down, but it's already recovering very, very smartly as we speak. So that's Eternal out of the way. Let's look at the rest of the market. Adani Ports 3.5% higher, and Adani Enterprises, which also reported numbers that looked good, up about 1.5%. Geo Financial is having a good morning, 1.5% higher. Hindalco, there's some buying on it, but I don't see too many other metal stocks. It's Hindalco, the lone ranger as of now. M&M, Sud was just telling us best in class as always, once again, 1.5% up after the April sales numbers. Tech is doing pretty okay today. Wipro, Infosys, it seems to be a little bit of a NASDAQ rub-off effect. HCL Tech, etc. All these stocks up. Reliance is helping the bulls this morning, 0.7% higher. So is HDFC Bank. So it's the big boys at the crease, and they're keeping things, quite supported, well supported. On the downside, Eicher Motors, 2% lower. Bajaj Auto, 1% lower. Let's look at Hero. Hero is down about 1% as well. Hero's numbers for April, the sales numbers were fairly disappointing. But everything put together, 100 up on the Nifty, so not too bad, Nigel.
Well, that's right. From the broader markets, a few stocks that are moving around. Railtel, that stock is up close to around 8%. Massive move is what we're seeing out there. JSW Infra, that's up close to around 2.5%. Big volumes out there. Reliance Power, actually, we had some news coming in on the exchanges. They've done a deal for some offtake. So that's moving on very, very large volumes, massive volumes in the first couple of minutes. So that's moving higher. NMDC, after a few months, they've gone ahead and effective a price increase of around 440 rupees. What's more interesting is the price increase is higher than what the street was working with. So the street likes it. Geo Financial Services, we pointed out earlier today that Reliance Industries seems to have found its mojo back. Most of Geo Financial gets its value from Reliance's from the holding they have in Reliance. So it has to play a bit of a catch-up. Then, in fact, maybe that's the stock to focus on from here on as well. So I'll keep an eye out on that name. On the flip side, you have Sonata Software. The stock ended high with a gain of 13% in Wednesday's trading session. Anticipating good numbers coming in from Microsoft. The numbers are good, but the stock seems to have priced in advance. So that's why that stock's down close to around 2.5% as we speak. And I think the sector of the day really is tech. That's opened up with a good gain. So let's pull up the IT index. You have the Bank Nifty that's up close to around 280 points. The Nifty IT index as well. We had lots of earnings coming in from, from the globe in the last couple of trading sessions, and it seems to have taken a hint from there because the Nasdaq as well did bounce back. I think pull up JSPL. That stock, in fact, initially did start off with a cut of close to around 3%. There was a lot of pre-positioning getting into those numbers. No big shocker, but it appears there is some routine profit taking that you saw. So that's why that stock is down close to around 2.5% or thereabouts. It's a good-looking screen. Some of those shots that were taken in Wednesday's trading session could be in for a bit of trouble if the screen holds as it is.
So it's an 80-point up move on the Nifty at this point, 85 now. So actually 24,420 at this stage coming through. Let's just quickly, I think we mentioned PNB Housing. PNB Housing is the number 2 big volume-led gain of the deal. The block went through in the morning. It's got 6% gains now, 1,073 on it. Coromandel, we'll speak with the management later. That's the 4th biggest volume-led gainer. It's about 4.5% higher right now. Moil is up 5%. Moil is coming up with about 332 rupees. Again, it's got decent-sized volumes for this point in the day. And Nuvoco, which also reported numbers, and I think there is strong profitability expansion. 8% on Nuvoco. Stocks at about 345. Coming through. And I can spot a few more, UPL, NCC, etc. But, volumes are still yet to pick up on some of these names at this point in time. On the downside, there is, some reversals, etc., which are going on. Phoenix Limited, the mall operator, is down 5.5%. And Eicher Motors is down about 2.5%. Federal, and the rest are all result reactions. I mean, I think we've mentioned those, which is Eternal, Indus Tower, Paris. As I said, 65% from the April lows. Paris is down about 3% post numbers. And Federal is down about 2% as well.
Just one word on Novoco. Those numbers were good. Actually, we put out a review and, the volumes were good. The profitability has jumped up as well. The debt has come down, which has been a problem out there.
Yeah.
The only concern is how do they ramp up some of those acquisitions going ahead? They have a con call later today, post-market hours. So we'll have to keep an eye out on the commentary. But the performance last quarter was good. And valuations palatable at around $70 on an EV per ton basis. Just one more word. We're looking at stocks, but I think we should pull up the Indian rupee. If I saw that correctly, the Indian rupee has strengthened and it's breached that 84 odd mark. Now it's at around 83.86. So good, recovery is what we've seen in the Indian rupee. Keep in mind, the dollar index was stronger overnight. That had breached the 100 odd mark. The yen, in fact, did show some weakness, but the Indian rupee seems to be the outlier. It's strengthened even more.
Money. The FPIs, maybe.
I think, so month end, there's a lot of demand for dollars.
Yeah.
So we've turned the month, and I think there is a little bit of a pop which is going on there. And of course, I mean, the big driver has been very strong foreign flows, equity flows, which I think is the head. And for now, the rupee is the tail. In that sense, Venugopal Gare is with us, Managing Director, Head of India Research at Bernstein. He's with us. Venu, good morning. Good to have you back on the program. Thank you for your time. What are you telling investors? What should they do?
Thanks, Prashant. So we're telling investors to buy. So that's been the case since January. When I changed my view from being cautious to relatively more positive on the Indian markets, and as you know, my Nifty target is 26,500. We are still pretty much some time or some large gap away from there. So our view hasn't really changed in terms of what investors should do. We use the operating word selective, but this idea was more to believe that we'll have a 10 to 12% returns for the headline indices, especially the large caps this year. So that's where we are.
That's interesting. Venugopal, great to have you on. So are you still telling people to buy? Because there are those who are arguing that if you strip out all the noise around tariffs, etc., if you just look at growth, look at earnings, it's still patchy. I mean, perhaps still at risk of more downgrades for this year. So intrinsically, does this market still offer opportunity?
Yeah, so there's two ways to look at it. Number one is more in terms of near term versus the next 6 to 8 months. So this market is not going to be a straight line up. So you will see volatility given all the global factors. But at the same time, if you were to just compare the earnings element of the risk, the earnings element of risk was substantially higher at the peak of the market, middle of last year. It was fairly frothy, both for large caps and mid caps. To a large extent, you've seen downgrades and revisions through the year. Many fag-end downgrades that we see today is more, I think, accounting and calculation related rather than macro narrative related. So I would look at the underlying positives, the fact that we have essentially started to improve on the macro front. We are relatively less impacted on the US tariff regime. That's the second positive per se. We're heading into perhaps a decent phase with respect to the rural environment. And more importantly, consumption and capex in our view are going to be better than what it was last year. So if we were to just rope in all these things together and also look at potential risk to global, I would say, recessionary impacts, which could bring down global volumes where India is not that impacted, could bring down commodities as well. So that gives you that margin buffer, which could potentially positively play out when we look at earnings. So if not upgrades, we're definitely not in an upgrade cycle. We are perhaps not there in terms of a deep downgrade cycle as well going forward.
Okay. All right. Hi, Venu. Good to see you, Ben, as always. I recall when we spoke about consumption, the last time around, if I remember correctly, I think you had added Jubilant. That was the stock that you liked. And I think Zomato was pulled out. How are you approaching the consumption basket from here on, given that, consumption is expected to improve as this calendar year progresses?
Yeah, fair point. So we did some tactical moves beginning of the year. Primarily, as you know, my consumption plays are DMart, Avenue Supermarts.
Yes, DMart.
That was preferred over a trend. So that's why DMart was introduced in the India portfolio. Jubilant, as you rightly said, replaced Zomato. Not that Jubilant has returned much this year, but it's probably ended up protecting the downside. We do think QSRs, selectively, including stocks like Devyani, would do well for the rest of the year. Part of it is improving momentum in general, and small ticket consumption, I guess, is an area of focus for us. This is the real test because tax cuts do play out in terms of improving momentum for a part of that consumption universe. Unlike last year, where I was outright negative on consumption, I am still seeking opportunities and trying to selectively enter into areas where momentum either has settled or is improving, and there are lower competitive risks. So I'm not getting back into eternal yet, but I do believe a lot of those challenges are starting to reflect in the stock price. But still, it might take some time before I reintroduce stocks like that.
But stocks actually done really well today. The market's seen this in a slight positive way. Perhaps some of the reasons could be that Eternal this quarter has decided to shut down some of the businesses that it didn't see too much value in. For instance, this 15-minute delivery, their challenge to Swiggy's Bolt. Maybe the market's saying that, okay, this is sort of a cleanup and a more focused approach, and perhaps that's what is getting rewarded. But anyway, good pickup from the lows on the stock today. Venugopal, what about financials? Obviously, it's no longer a straight line. It's not, you can't paint everything with the same brush. There's a lot going on, especially in tier 2. I mean, NBFCs, for instance. Shriram was a bit of a disappointment. We've seen some issues, wrinkles with Chola as well. So, how are you looking at lenders, and what would you pick? What would you strictly avoid?
Yeah, so my idea of being overweight in financials this year was a pretty broad-based one because I had a fairly large overweight. So this was my highest overweight sector heading into the year. Part of that was my view that cycle is essentially going to favor growth. A change in dispensation with respect to approach to liquidity from RBI, which was more visible from December last year, also gave comfort. So lower regulatory scrutiny, these are all the aspects which positively play into the overall financial sector in terms of opportunities. So the way we were looking at it was banks. I wasn't a big fan of NBFCs per se. Of course, you can selectively pick things here and there, but my portfolio was stacked up more towards banks, followed by insurance, which was more defensive for me as well this year, given that a lot of the regulatory noise I felt had already reflected in stock prices. So these are the two ways in which we've been essentially trying to play the financial sector. And I think the question from here would be that, look, this sector is already outperformed. So does it really make sense to remain invested? I really think it's still early stage in the sense that, look, stocks have moved up, but they're still not as costly as they used to be in the past. And relatively, you don't really have other sectors which are cheap. So we're still playing for the next 10% return from here. And I think financial sector can over-deliver on that.
I've got that. Venu, what's on your small cap list?
Yeah, I mean...
whatever you've published, I mean, so it's out in published reports, yeah.
Yeah, what's so, I mean, look, honestly, I'm not too small cap heavy.
I know. But what is on that? So that's why.
So, small cap is a part of my India main portfolio at this juncture. I guess the only stock I have can be categorized as small cap is Jubilant. That's the only one, perhaps, from what I recollect. There's nothing else small capish. I used to have a separate mid portfolio where we had some ideas last year, things like Dixon or Keynes and others. But that mid portfolio is largely suspended this year because we don't want to really play a pure SMID strategy. It can be extremely risky in terms of a volatile environment.
Yeah. Venu, in terms of feedback from foreign investors, and you do a lot of these trips to the US and other parts, and you meet a lot of the large allocators, what is the feedback on India now?
Feedback on India is a bit mixed. Global investors were underweight in India in February. They were overweight on India in July. So firstly, it tells you that positioning-wise, perhaps they are not the best judge in terms of approach to India. But leaving that aside, I guess most of them are progressively looking at India in a more positive light as compared to other countries within EM universe. Part of it is driven by recovery in macro, and part of it is driven by the broader theory that India is less impacted in times like these when there is global upheaval on the trade front. Does it mean that there's going to be a major allocation shift from China to India? Tough to say, given the relative valuation differences are still very large. But I do guess that my thinking was FII outflows were done. So in March 15th or something, I had written this report, which was based on 100 meetings, which primarily said that if you're already underweight and you've seen such a large swath of FII outflows, you should not see any more outflows. So FII outflows bottomed out. Incrementally for the rest of the year, are you going to see a massive resurgence of flows? That is tough to say. A lot of volatility factors out here, and also depends on DM to EM shift in money, which is still a question mark at this juncture. So EM funds need to be able to raise money for us to see incrementally a lot more allocation to India. But overall positive. I actually saw domestic funds being a bit more negative and cautious with respect to India. And I guess part of the questions that you asked in the beginning around earnings, there is a general worry that there could be earnings risks. So domestic funds seem to be more cautious than international funds.
Okay, all right. I remember the FI holding in the Indian markets had gone down to the lowest we've seen in more than 10 years, when it came down to that, I think 16.5%, 17% or thereabouts. And now the hot money is coming in as well. And as we had that chat with you, Venu, seems like the street was listening in. The markets have moved to the high point of the day. We have hit the highest levels since 17th of December. But as you're making that important point, earnings could still be at a bit of a risk.
Just to conclude this point that Venu is also making, Venu, completely take your point, right? Domestic funds and domestic investors are more wary of earnings. FIs are not. But from their perspective, I mean, this is still best in class, right? In a world which is, God knows, recession, degrowth, what we have in terms of tariffs. So perhaps that's what's getting in the FI buying. But thank you very much for joining in. Great conversation this morning. Thank you for being with us.
All right, let's focus on our next management then. Sona BLW, that's the one that we're going to be looking at. We have with us Mr. Vivek Vikram Singh, the Managing Director and the Group CEO at the company. Hi, Mr. Singh. Good morning. Thanks a lot for joining in. Well, the stock started off a little in the red, but it's recovered from the lows. Before we get to the margins and other aspects, let's talk about the globe first. We have this entire tariff situation that's playing out. According to your analysis, how much of your business is at risk owing to these tariffs that have been announced close to a month ago?
Sure. Good morning, Nigel.
Morning.
The globe's still round, so it's still spinning. The world goes on. The tariffs bit, I think there was a recent relief announcement, which has been fairly positive for our customers because most of them are actually almost all are domestic assemblers in the US. So it's been fairly positive. But I'll just break it down. We have about 40% exposure to the United States. 30 out of that 40 is direct to OEMs and 10 is to tier ones. Out of that 30, 20 is in HSN codes, which are actually not covered under auto HSN codes. So they are in reciprocal. So there is about 10% tariff right now. Let's see what the BTA negotiations and how they go. And if it goes positively, I think that's at pretty much no risk. The remaining 10% is pretty much done in the US for our US customers. So it's US to US. And there too, the impact is pretty much nothing. Now come to the last 10%. So we've done a line by line, program by program analysis. And what we've concluded that 70% of it is, I would say, places where it's very, very hard to replace us with anybody local. 3%, I would say, is what could be at risk in the worst case scenario of our total revenue. So that's where it's at as of today. Now, tonight, someone can announce something else and things can change. But as of today, this is where it stands.
Vivek, I'm hoping for a good weekend. I hope he doesn't announce anything today. But let's focus on a couple of other aspects. X of the PLI, actually the margins were a little lower than what the street was working with. The street has taken it in its stride because after opening up in the red, the stock has actually recovered. What is the margin guidance you can give us for this year? And also, if you could help us out with what kind of a rough revenue growth you're looking at. It appears for the time being, the risk of losing business will be low single digits. So if we are to give an estimate as of now, if things change, then we won't hold you to this guidance, but otherwise a range on the revenue aspect as well as margins.
Yeah. So, Nigel, in the last 4 years that you've been talking to me, I've never given guidance. So I'm not.
But nothing wrong in trying again, right? You could give us a range. I'm sure you'll want to give us a hint at least. Since you've given us a 3% number, I said maybe you'll want to give us a growth guidance number as well. Go for it.
No, growth guidance is something we have intentionally stayed away from. And right now, when signal to noise ratio is perhaps the lowest it's been in the last decade, it is a very bad precedence to set. So we won't give growth guidance. We will have growth, of course, because we've also added a new business, right? That starts from 1st June. The railway business starts getting added. So a lot of things to look at. And on 2nd May, to be honest, to figure out what the impact of tariff that are going to come into play on 3rd May is beyond my abilities.
Okay, got that. Vikram, hi, good morning. Prashant here. You said 3% of total revenues can be lost to lower cost suppliers in the worst case because of tariffs. That's your assessment.
Correct. And they're not really lower cost. They're lower because at one, they are not lower, but when it becomes 1.25 to our customers, of course, it becomes different. But see, in this scenario, right, the only people who can do it is people who have local capacity in the continental United States, not anywhere else, because everyone else has the same problem. Actually, prices for our customers just went up by 25% for everybody. That's what they've done. For the HSN codes that are not covered in auto part list, they went up by 10%. So unless there is capacity and capability to do that part in United States, it is not possible to touch our business. And even that takes 12 to 18 months in our ability to shift.
And that 30%, 40% exposure to the US, you said 30% is to, so 30% it's the reciprocal part, not sector-specific tariffs, right?
So 30 is to OEMs. In that, 20 is reciprocal, 10 is non-reciprocal, but that 10 is where we are actually supplying within the United States to our United States customers. Second, this tariff relief actually, for most of our customers, the domestic value addition is greater than 80%. So if you look at the rebate for the next 2 years, they have to shell out pretty much nothing to cover all the cost of the extra import tariff.
Vivek, hi, morning. Just one final point on tariffs and this whole global situation. What is the mix right now? If I talk about the total revenue pie for Sona, how much is exports, how much is domestic, and what are you looking to maintain given all of this volatility and the shifting positions internationally?
So we don't segment by exports, we segment by end markets because we produce everywhere in the world. We have a plant in China, 2 in Mexico, 1 in the US, 7 in India. So it's 40% exposure to US, 30% to India, 24, 25 to Europe, and 5, 6, whatever the remainder to rest of Asia, China plus Southeast Asia.
Okay, so now just tell us, because you also have exposure to Europe, let's leave out US, which is the whole tariff situation, but your business to the US, is that taking any kind of a hit at all because of delays in decision making or sentiment shifting or OEMs being unsure about what they want to do in terms of expanding their supply lines?
Great question, Sukhit. So we have actually on an earnings call called that out, that although we don't know anything yet, because it's just April, right? April had no impact. We do think that there is a possibility that there will be general slowdown everywhere in every single market. And what that will be and how much, we don't know. Also, it will depend finally on what these tariffs settle at, right? So far, nothing has happened. But if this does happen, a global trade war would not be good for anybody. You cannot hide from it.
Yeah. No, absolutely. And I think that's the bigger one, right? The indirect impact, the slowdown, which will, I think, affect everybody. And that's absolutely impossible to quantify. Vikram, we're out of time. And I wanted to ask you about humanoid robots. That's the interesting stuff.
Yeah, that really caught our eye. But maybe just 10 seconds. What exactly are you looking to do there? A humanoid robot?
Okay, so I'll try to be very quick. Humanoids are where electric vehicles were in about 2015, 2016. That's when we started getting into electric vehicles. 50 to 60% of the BOM of a humanoid robot actually comes from parts that are well within our capability set.
BOM is bill of materials. 50 to 60% you can make. Yeah.
Basically. Yeah, so gears, actuators, motors, these are the things we make. Prashant, anything that moves needs a motor, it needs a gear system, and it needs some sensors. So you can theoretically go into everything that moves.
We will have you back on. We will have you back on.
Yeah, the stocks will chat.
And I think these are a very, very interesting space. I mean, and there's a lot to talk about here. Thank you very much for joining us with that perspective, and great to get that. Bandhan Bank is the next company that I want to focus on. Numbers came through, and we have. I mean, the question with Bandhan, of course, it was a bit of a weakish quarter once again. The question is have we seen the worst? And will things start to improve dramatically over the next few quarters? That is the market expectation. We have Mr. Partha Pratim Sengupta, Managing Director and CEO at Bandhan Bank. Sir, thank you very much for joining us. Good morning, Prashant here. So my question is exactly that, sir. Have we seen the worst? You know, over the last few quarters, we've seen Bandhan kind of recognizing bad loans, etc., at a very accelerated pace. You know, taking all the pain in. Have we seen all of it with this fourth quarter numbers, and will things look much better from here out?
Precisely, I can say another 2 quarters will be a challenge, but not to the extent what we have seen in Q3 and Q4 of the last financial year, that is 24-25. The delinquency book is definitely improving, so the slippages would be much lesser. But yes, the microfinance segment, as you know, that the entire country has been affected, and we are also not insulated again from it. So a little bit of challenges would be seen in Q1 and Q2 of the current financial year. But Q3 and Q4, we are expecting a very good, I would say, for results from the microfinance segment. And definitely, I think going forward, the things will again be as better as we have seen in the previous 2 years back, especially in the pre-corona period. So this sector is showing improvement, but albeit at a little bit slower pace. That much I can say.
Q3 numbers, that is October to December, numbers should go back to where they were pre-COVID, basically, by Q3.
We are expecting that, yes, definitely there will be much improvement. Q3 and Q4 of the current financial year. Q2 and Q1, I would say that, yes, the slippages won't happen, but definitely at a much lower pace. The rate would be much low for that. We are seeing that there is a sequential improvement in our delinquency book, which is a very good sign.
Okay. All right. Hi, Mr. Sengupta. Good morning and good to see you in. Nigel on this side. Give us some numbers. How do you see the credit cost panning out for the remainder of this year? You're guiding that better times ahead. So in the first half of the year, what will it look like? And then how do you see a recovery from there?
So you see the credit cost for the entire financial year was 2.9%.
Yes.
And the way we are going forward, I think this year we may end up something around a little bit over than 2. So the entire year we are aiming at around 2.3, around that. But again, this will depend on a lot for that year. The first of all is that we have to decrease our loan loss provisions. So that will definitely come because we are now very adequately provided. You see our PCR ratio, including of write-off, is almost 87%. And without CR also, we are about more than 73.7%, so which is almost 74%. The microfinance book is almost close to 79%, the PCR. So we are sufficiently provided. So going forward, we are finding that with the improvement in our loan book, and that also you have seen that we are now turning more universal. We are going towards our secured books. So our secured books percentage has increased from 42% to 50%, 50.5 during the last year. And our target is that we should reach by 55%, 50 in the next 1.5 year or 2 years for that. So that is our goal. So with this secured book position, definitely I would say the quality of assets would be better. The microfinance area of this segment is also showing some improvements. So from Q3, Q4 onwards, it will come. So our target is that within next 2-3 years, we should contain our credit cost and bring it below 2%. So that is our target for the year, and we are working on that.
So 2.9% comes down to 2%, and just going through a couple of notes, I believe that in the next 3 years,
this year will be around 2.3, 2.4.
2.3, 2.4, and then gradually you're looking to take it to around 1.5, 1.6 over 3 years is what I understand.
Yes,
Got
yes,
it. Okay.
absolutely.
So we got the near term and the longer term guidance. Give us two key numbers then, sir. What is your advance growth you're expecting for this year, advances, if you could help us out with that? And how do you see the NIM spanning out as well?
So, number one, regarding advances, we are looking for a 15 to 16% growth for this year. And as we have aimed and we have also tried from last year and we have been successful, that our deposits growth would outpace the advances growth. So deposits growth, we are increasing a little bit more than the advances. CD ratio, as you have seen, that we have brought it to 90.5% for that year. So almost that same ratio will continue, but maybe a little bit high or low. Going forward for the NIM, you see the NIM would be moderated. We have told very clearly from Q3 onwards that as we are moving towards a secured book, our NIM would be moderated and it will be further moderated a little, but the volume would definitely increase so that there is an overall improvement in the actual figures in the profits.
So where should we, on a steady state basis, where should NIMs be? If you can give us some guidance.
So we are around 6.4. We are looking. We're steadily coming down. So you see, this quarter it was around 6.7. So it may come to around 6.4 around.
To about 6.4 or so. Got that. You said you should go back to pre-COVID kind of performance post starting third quarter, right? You would have recognized all the old stress, new stress, of course, we'll have to see and take it as it comes. And you're not alone, the industry is facing it. Could you give us a sense of, what that, when you say go back to pre-COVID kind levels, what are we exactly talking about, sir? Just give us some sense.
Let me tell you, by pre-COVID sense, I want to mean that the slippages would come down substantially. That is the thing. The NPAs would be contained at a much more higher level. Number two, for the day. So, and this is, I'm talking about the microfin sector. The other sectors, as you have seen, that our book is quite healthy, whether it is the corporate book, which has got a little bit more than 1% as NPA, so which is quite healthy for the day. The housing, finance, whatever the NPAs are there, most of the cases are legacy cases, but that is also being now contained. In respect of the wholesale banking, and I have told you the other sectors also in the retail. So I think the book is quite better for that year. So there is no worry on those fronts. The only worry that is coming is from the microfin front, and where I was witnessing that the delinquency level sequentially is coming down. So that is a great signal that going forward will definitely come down.
All right. Very quickly, sir, before we let you go, your OPEX spend has moved up. I think you have guided for that, which took your cost to income ratio to around 54%. What do you end this year with? If you could tell us, because you have said you're going to continue to focus on that aspect. And also the ROAs are still very, very subdued. Where do you see the ROA headed? Both these two, cost to income ratio and ROA. Go ahead, sir.
So as regards cost to income ratio, while the Q4 is high, it has always been high. It has always been high in the previous quarters because, many of the costs come in the Q4. But if you look at the whole year figure, it is around 48.56%. So that is, I think, quite reasonable. So we have added people as we moved into the other sectors of the businesses. We have also invested in technology, and there will be further opening of branches. And also last year also, I'm talking about 23-24, we have opened close to around 240-50 branches. So all those costs have added up on a full year basis during the previous financial year. So that has actually led to an increase in the cost income. But now we are waiting for getting returns from what we have invested. So going forward, I can say that while investments in our resources and investment in skills will continue, but definitely whatever we have invested in the past, that return would be coming. So the cost to income ratio would be contained, and it would be contained at the same level around 48 47-48%. That's what we are aiming at. This is the first thing. And regarding the return on assets, so you see the overall return on assets was 1.5%. Our target is that we should reach close to 1.8 as soon as is possible. But again, as I've told you that this year, maybe the return on assets will be around 1.5, 1.6 from the simple logic. Because previous year, Q1, Q2 has been good. Q3, Q4, there were challenges. This year, we are expecting Q1, Q2 will have challenges, but at a much lower level. And Q3, Q4 would be good and maybe better than what we have done in Q1, Q2 for the last financial year. So going back, simple trade, I can say logically that 1.5, 1.6 ROA, we will be able to achieve this year.
All right. Thank you very much for joining us. Good speaking with you. It's a pleasure, having you with us with that perspective. Look at the market go. There's a really good bounce. 200 points now on the Nifty, 24,540. And you got some 2.5:1 in terms of advances to declines as well. So overall market doing very, very well. Financials is what we are continuing to focus on. I think we have the Federal Bank Management with us.
Well, that's right. Let's get straight to Mr. Harsh Dugar, the Executive Director at Federal Bank. Good morning, sir, and thanks a lot for joining in here on CNBC-TV18.
Good morning, Ajil, thank you.
Let's get to a couple of aspects then. Your growth has slowed down a little bit. Could you tell us what is the outlook from here on? I believe that you're planning on outpacing the industry growth from here on. So what kind of growth are you looking at for the industry?
Okay, so I'll take a step back. I'll speak about the quarter first. If you look at it, 1/4 of our assets was basically in gold and housing loan. And housing loan, we had consciously decided to go slow, given that the pricing was sometimes bordering towards irrationality. So that was one. In gold, because of the regulatory announcements, and there was a little bit of an ambiguity, and different players were interpreting it different way, led to a marginal degrowth. But if you look at it otherwise, we have been growing some of our assets, which we have been saying the medium yielding assets, in reasonably good manner. If you look at our MSME book, it's been growing at 20% YOY. If you look at our cards business, it's about 19%. So we're looking at growing our core mid-yielding assets and high-yielding assets in a significantly better way. So the idea would be to have a thrust and focus more on the medium-yielding assets, and subsequently, as we progress during the course of the year, on the high-yielding assets. So this is how we are. In terms of how we are guiding, we have always been saying that 1.2 times to 1.4 times of the nominal GDP growth is where we are looking to peg our growth rate on advances at. So this is where we would like to guide the markets at.
Okay, in percentage terms, so what would that be? You're aiming to deliver around 1.2 to 1.5 times of banking system growth, right? So what are you factoring in for the banking system then?
So we are saying that the banking system looks to grow at about 12%, 12 to 13% is what people have been saying that. So we've been saying that about 15 to 17% would be a broad range. It obviously depends upon the outlook. The tariff wars have also created some sort of an ambiguity in the minds of many of the corporates. So we look at how this shapes out. But broadly, what we are guiding is about 1.2 to 1.4 times over and gain market share on the advances piece.
Okay, got it. All right. We're just hoping that tonight we don't hear anything coming in from Mr. Trump. Everyone wants to have a good weekend. He doesn't seem to be giving everyone, too much of sleep. But let's focus on your business. Where do you see your CD ratio settle at?
So CD ratio is about 83% odd. We've been saying that about 80-85%. We plan to we always believe in fund before you lend kind of an approach. The good part is in the last couple of months, the pressure on deposit has actually eased out. RBI has actually infused substantial amount of liquidity between a CRR card, OMO operations, and other steps taken by the RBI. So there is surplus in the system right now. Deposit rates have fallen. So to that extent, I would say that the CD ratio doesn't look to be under pressure at this point in time. And also the advances growth for the system as a whole, if you ask me, has slowed down a bit, partly because of the unsecured PL piece slowing down, the corporate book in general for the system as a whole slowing down. So the CD ratio is not under pressure for us or for the system as such now.
Mr. Dugar, hi, good morning. Could you give us a sense on, so high-yielding loans, is that, what's the as a total percentage of total loan book, what is that at?
So as a percentage of our total loan book between high and very high yielding assets, just about 5%. This constitutes of credit card, PL and MFI loans. So in credit cards, we've seen a growth coming in and we've seen a reasonably robust growth. In personal loan, because of the stress in the system last financial year, we had consciously gone slow, but we're looking to getting this back again in this current year. MFI, we would like to wait and watch for 1 or 2 more quarters to see how while the things seems to be bottoming out, and there seems to be some green shoots in terms of collection efficiency improving. But there are certain states where we are still watching very carefully as to how that will shape up. Karnataka, Tamil Nadu now after the recent announcement, we would like to be watching it closely before we take a call to grow this book. We grow the MFI book for sure, but not at this point of time. We'd like to take a bit of a pause, be a little cautious and calibrate the growth.
This sharp, I mean, it's only 5% of the book, but it's this sharp deceleration, right? About 10% growth now compared to 20% plus same quarter last year. Some of it, of course, is deliberate as well, as you're pointing out.
It was quite conscious, yeah. It was quite a conscious call. See, it's easy to grow this book. It's never difficult for any bank, for that matter, to grow this book. It's a conscious call that you don't want growth, you want asset quality. And asset quality remains, because it's more important that you get back your money, what you lend. So that's what the focus is.
Yeah. So on an overall basis, I mean, what were loan yields at in this quarter, the quarter gone by, and what can we expect on margins? Is there going to be a slightly downward pressure, even with rate cuts, etc., coming through?
The yields we obviously did because we've already seen 2 repo cuts. One happened in Q4 and one in the current quarter. So definitely the yields are under pressure and likely to be, because most of the people are expecting 2 further rate cuts to happen, if not more, at this point in time. So there will be, and what typically happens, the yield comes off before the cost of deposit starts coming down, right? So the NIMs will always do a catch-up with a lag. So we do expect the NIMs to be under pressure. Answer is yes. Now, how are we addressing this issue? There are a couple of things which we have done. If you recall that we were already on the first few banks to cut down the rates on a savings bank by about 25 basis points. So that's come after the 2 rate cuts. That's number one, which would help us. Second, the thrust is more on the CAR piece of it when we're doing a deposit mobilization. So if you look at it, the CAR growth in particular for the bank has been very good in the last financial year. We grew about 35-36% in the last financial year on the CAR piece itself. And that's zero cost funds for us. So the share of CAR in our overall book was at 6%. And today in March 25, as we spoke about, was well above 7%. So the mix in the liability side is also changing. That's the second part. Deposits have also been repriced, but that will be for fresh. And hence the benefit of a lower cost of deposits will come with a little bit of a lag. On the asset side, 50% of our book is actually repo linked, so that obviously faces pressure. But over here also what we are looking at doing is we can do the interest reset at T+1, which we are on the few banks. We're looking at moving it to anniversary dates plus 3 months, which is regulatory permissible. So this will give us some time of a lag to reprice our asset book also. The another piece on the asset side is regarding the asset mix, like I mentioned earlier. So the focus will very clearly be on the medium yielding assets, commercial vehicles in particular. We are looking to grow that book sharply. We grew 35% last year, and we're looking to grow that also this year. MSME remains a clear focus. We grew the MSME book as a whole, we grew about 20%. We're looking to grow that again in a significantly better manner. So between a good asset mix, managing your yields because of the repo cuts, looking at fixed rate loans wherever we possibly can, are the various steps which has been taken by the bank in terms of ensuring that we kind of reduce the pressure on the NIM.
All right. Closing comments before we let you go, Mr. Dugar. NIMs, what does it mean? The benefits of lower cost deposits will flow in with a lag. You also said yields a little bit under pressure. What is the NIMs we should be working with? And I'm looking at the slippages. Last couple of quarters, it's been ballpark around 500 crores. How is this number likely to pan out? Please go ahead.
So if you look at it, our asset quality has been at a decadal best. Our GNP at 1.84 and net NPA at 0.44, which has been good. Our credit cost for the quarter was about 26 basis points. And for the full year, just about 38 basis points. We have been consistent of being conservative and ensuring our asset quality. So I don't think we see a threat. We've been guiding the market at 40 to 50 basis points in terms of credit cost, which is what we are maintaining at this point in time as well. And we don't see, very frankly, any significant stress or anything blowing up which will cause any kind of a concern. The MFI stress, which was of a concern, seems to be bottoming out. We'll watch for a quarter or 2 more, but this is where we are at. So if I have to guide you for an asset quality in terms of credit costs, I think we are guiding at about 40, 45, 50 basis points.
Got it. We'll leave it there. Thank you very much, Mr. Dugar, for joining us. We wish you all the best of luck as you get into F526. We take a quick commercial break here. We connect with the management of Coromandel International on the other side on their 4th quarter numbers and outlook. Okay, welcome back. You've got the market, which is up 250 points. I mean, this is looking good. 24,600 is where we are now trading at, which is at the day's highest point. I mean, actually, been trading for about an hour, but that's the picture. For the week as well, by the way, we are up about 2.25% now. And of course, today's 1%, adding quite a bit to the overall situation. Coromandel International is the next company which is on our radar. Reported a good set of numbers for the fourth quarter. Overall results are better than expectations, while margin growth came in slightly below estimates. We are now joined by Mr. S. Sankar Subramaniam, Managing Director and CEO at Coromandel International. Sir, good morning. Good to have you here. Prashant this side. Let's just start with specific segments. What kind of volume growth are you seeing for the nutrient and CP segments for FY26?
Good morning, Prashant. Thanks for talking to us. As you said, Coromandel has reported a good set of performance for Q4 as well as for the full year 24-25. Thanks to overall good agriculture environment. As you know, the Rabi season which completed was very good. India is likely to report another year of record food grain output, thanks to supportive government policies as well as the resilience of the farmers. And Coromandel, being in this space, has reported a good growth in volumes. In fact, on a quarterly basis, quarterly volumes for the quarter has been significantly higher by 19%. It moved up from 5.9 lakh tons to 7 lakh tons. And also on the full year basis, we have achieved a record volume of close to 40 lakh tons of NPK fertilizers. And our SSP volumes have been 7 lakh tons. So overall, it's been a good, satisfying year on the nutrient side. But it's very happy to note that even the agrochemical business segment has grown now very well. We have grown by 24% revenue growth in Q4 alone. And for the full year, we have achieved 7% growth. Thanks to our increased volume of exports from active ingredients, improved price realizations, and introduction of new products in the agrochemical space. We have recorded good growth in the profitability of agrochemicals, which has moved significantly from 290 lakh tons to 290 crores to 363 crores. Looking ahead, I'm sure we will continue to maintain this growth trend. Of course, in the case of fertilizers, it's a function of capacity and continue to operate the plant at full capacity utilization. As you know, last year we announced a project to add the capacity of 1 million ton of fertilizer, which will come through in the year 26-27. And we are also embarking on debottlenecking projects that will aid the growth in volumes in the year 25-26. In the case of agrochemicals, definitely we look forward to a high double-digit growth in the revenue terms and supported by good profitability with the introduction of new molecules and as well as new products which are in the pipeline. And also on the retail front, where we are one of the largest player in the agro segment with our own retail outlets. We have added close to 100 retail outlets in
Sorry, just to running a little short on time, so allow me to come in. So high double-digit growth in agrochemicals in FY26. On the nutrient side, sir, what should we expect?
In terms of the volume, we will try to expand our volume by 5 to 6% because it's a function of capacity what we have, and already we are operating at full capacity. But as and when the new capacity comes up in the year 26-27, we should be able to increase our volumes. So next year we can expect 8 to 10% of the volume growth on fertilizers, including the traded volume.
Okay, all right. So hi, good morning. Good to see you, Ben. Tell us about demand and crop protection. How is that? And since you have gotten, you've done some inorganic growth, NACL is going to be coming into your fold. How does it change the dynamics, your market share, as well as profitability going ahead?
No, in fact, we do expect revival in the agrochemical space, which witnessed challenges in quarters in the earlier year. And coming years, we do expect the improved price and improved sentiments and increased demand for agrochemicals and the introduction of new products from our own portfolio, which be able to see a good growth in revenue. And the NACL, still we are ready to get the regulatory approvals, maybe too premature for me to comment on that. But overall, we see a good recovery in the price trend and the demand uptick is there. So with the good onset of monsoon expectation, the Kharif, all the IMD predictions indicates a positive monsoon. So we do expect increased demand for agrochemicals, both in the domestic market as well as in the export market.
No, I get that. Overall, sir, can you give us a sense of what FY26 top line can grow at?
In case of nutrients, as I mentioned, 8 to 10% of the revenue growth, and in the case of crop protection, it will be a high double-digit growth on crop protection segment, and we are looking to expand our retail footprint from currently what we have 900 stores, likely to go up to 1,400 stores, and that will also aid the growth of agri inputs across. Besides that, we are also looking to grow our service business, which is drone spraying services, which we are expanding across India. And also, we are trying to do seed marketing for fertilizers in the northern markets, anticipating our new capacities. So all this, we can expect double-digit growth in top line and supportive EBITDA as well.
Just one quick question, sir. Is there any senior management sort of changes, etc., which are being contemplated at the company?
No, as we have communicated after our quarterly results, Mr. N. Srinivasan, who is our Murugappa Group veteran, has joined us as Executive Vice Chairman. His financial acumen, his business expertise will definitely help as Coromandel embarks on this journey of growth in the next few years. And also, there is a change in our Chief Financial Officer. Jayesh Sadagopan has decided to move on, and we have got Deepak Natarajan as the Chief Financial Officer. All this has been approved by the board in the last board meeting.
I see, Mr. N. Srinivasan, Vice Chairman, at joining. Of course, as you said, Murugappa Group veteran there. Thank you very much, sir. Good speaking with you. Appreciate your time here on CNBC-TV18, and we'll speak again. Thank you. We'll just focus on what's happening in commodity markets. Manisha is here with what is top of mind. Gold certainly is not top of mind. Gold prices actually from the recent highs are down about 5% or so. The other one, I think, which Manisha will talk about is oil. Big drop, big drop, Manisha.
Well, the wrong guess, really, yes, but crude oil prices did see a decline of 2% on Wednesday. But one thing that also has seen a very sharp decline coming in, Prashant, has been the copper prices. Fell 5% on Wednesday, saw some more decline in the markets yesterday. The US fell 5%, while the LME copper prices declined by 3% on Wednesday. It has been a very sharp decline that we have seen come in for copper, and I'll shortly come to the fundamentals as well. But traders have been unwinding arbitrage positions across US, LME and Shanghai. Those are the three important major trading markets in the global markets there. And we have seen premiums and discount work there. So we've seen a huge unwinding. And the unwinding has happened because China is headed into a long weekend. It's a 5-day holiday, Labor Day holiday in China. And that really has led to markets being shut there. And we have seen a lot of unwinding happen because of that there. Well, markets also are reacting to the weak US GDP data. The numbers clearly have surprised on the lower side there. And when you look at the China PMI number, that also came in at a 16-month lows. We've seen export orders at the lowest since 2022. So very weak economic numbers coming in from US and China has been yet another reason that you saw sharp decline come in for copper prices. Well, US is reviewing potential tariffs on copper imports, and that has kept the copper prices on the higher side. But with the easing of tensions between US and China, that has led to some profit taking coming in, not just in gold and crude, but in copper as well because of that reason. The copper prices, though, could be looking at some support going forward because there are supply concerns in Peru. The two important mines, Antamina and La Bambas, are looking at unrest with the workers there, and that can be supportive. But most importantly, what the copper prices will react to going forward from here is really going to be the International Copper Study Group numbers that came in over the last day. Well, if you look at the markets, they are anticipating a surplus going forward. We did see a surplus in 2024-25, could be looking at almost a double of a surplus there, and above 200,000 tons of a surplus is anticipated for 2026 as well. Now, the ICG also is talking about the world mine production, and here as well the numbers are quite on the stronger side. In the last few years, we've seen mine production increase by 2%, and while 2025 is anticipated at 2.3%, next year could be higher at 2.7%. So we're looking at higher mine production and higher inventories as well. So surplus is what the street is working with. The world smelting capacity also is expected to increase by 2.9% in 2025. And when you look at copper smelting, it is about Asian markets here. Whether it's about China, India or Indonesia, this is where you will see higher smelting capacity come in from. Take a look at the demand numbers there as well. So while in 2024, we saw demand gain up by 2.8%, it is anticipated lower in this year because of tariff concerns and recession concerns as well, weak economic data as well. And when you look at the consumption, that is expected to go even lower, below 2% in the next year. And that is what really seems to be bothering the copper prices. So while we have seen all-time highs in US for copper in this year, whether those prices will come back yet again in this year, the street expects that not to happen. What is that in focus today is going to be the US non-farm payroll data. While the longer term for copper is still under pressure, the near-term cues clearly would come in from this data.
Absolutely. And that's later today around the time that US markets open up. Manisha, thank you very much for that. So that's commodities in focus. We take a quick commercial break here. On the other side, it's our special segment. It's the economy. Lata in conversation with Lord Mark Sedwill of Geopolitical Advisory for Rothschild and Company on the global divisions post-Trump tariffs. Stay tuned.
Welcome to It's the Economy. In the past month, geopolitics has become a more important factor for corporate boardrooms and financial markets than probably it has ever been. Most corporates are not designing capex plans, not deciding what product they would make and where they would make, because tariffs would depend on what they make and where they make. Geopolitics has become so important. So today I have with me a guest who can perhaps help us understand how the current geopolitical turmoil will pan out into geoeconomics and what may be its end game. I have with me Lord Mark Sedwill. He is the geopolitical advisory for Rothschild and Company. He has in the past been UK Cabinet Secretary. He has been National Security Advisor for the United Kingdom and has served in diplomatic positions in several countries in Asia and the Middle East. Lord Sedwill, thank you very much for sparing time.
Thank you so much for giving me the opportunity. Very good to be here.
Well, so let me start at the for an Indian audience. You know, this entire US-China war, in India, people try to look at the optimistic angle by saying that we are probably going to be beneficiaries because production may partly shift to India, or in a Cold War between US and China, US may lean in favor of India. Are these fair assumptions?
Yes, I think they are. I think there are opportunities for India. And I think one of the things that is not well appreciated, actually perhaps in Beijing or Washington, is that the world is not actually going to coalesce into a sort of blue team and a red team, one around the United States and one around China. Many countries, and India probably most prominent among them, have a strong tradition of non-alignment. Now, it's a different non-alignment to during the Cold War, but India, Indonesia, Brazil, Saudi Arabia, South Africa, indeed many European countries are determined to have a positive relationship with China and a positive relationship with the United States and not be forced into a choice between the two. And as you say, there is an opportunity for India, partly because the Chinese economy is not booming to the same extent it was before. Labor costs are rising there. The population is actually now declining. It's a fast aging population. So there are natural economic reasons for production to move offshore from China to the ASEAN nations, to India. But of course, there are political reasons as well because of this tension between the US and China. And so I think India India has very real opportunities in the decade ahead.
But would some of these be taken away because China could come with reprisals against those who are seen being favored by the United States? They even seem to have threatened some countries. The old African proverb, when elephants fight, what happens to the grass? Could there also be negative if one leaned in any fashion?
I think that's right, which is why I made the point about non-alignment. I mean, people use fancy new terms for it, but fundamentally it's the same phenomenon. So India has always had that tradition, and so I don't see India and other countries taking the position they're taking as essentially putting at risk some kind of retaliation, because India isn't going to align 100% with the United States and it isn't going to align 100% with China. Of course, there are risks in this. Both sides might try to put pressure on other countries essentially to do that. But India's a big economy. India's going to be the third largest economy in the world within the next decade or so. And so India's too important a country to essentially have to buckle to that kind of pressure. And let's not forget, it's many Chinese companies themselves that are actually offshoring production into ASEAN and into India. It isn't simply Western and Indian and other businesses doing that, but Chinese businesses themselves are doing it just for economic reasons, because they want to find places where there's a big consumer market and indeed where labor costs are lower.
No, they're already approaching India for those reasons, and it is India which is being wary because we have had border skirmishes quite recently.
Yeah, indeed.
Now, coming back to China's trump cards, if I may call it that, they do have a very dominant position in heavy rare earths and heavy rare earth magnets. Can they really drive a very hard bargain against the United States? Can they bring the entire EV production to a standstill?
Well, I think there are risks of that. As you say, they have, depending on which one you look at, they have a near monopoly in the production of some of those critical raw materials. And of course, they've become dominant producers of batteries, dominant producers of solar, and so on. But of course, they also need markets. So they could, should tensions, political tensions between the US and China rise, that kind of risk could manifest itself, whether sanctions from the US or essentially China choking off production. But the United States needs this Chinese production. China needs markets. And one of the things that is wholly different to the US-Soviet relationship during the Cold War, and I think we still must refer to it as the Cold War and not the first Cold War. We're not yet in the second Cold War, and let's hope we can avoid that, is that the economic relationship between the US and China is so much deeper than it was between the United States and the Soviet bloc. And there are strong incentives on both to avoid tensions getting out of hand because of the economic damage, as well as the security risk, but because of the economic damage that would be done to both countries.
No, you put your finger on it. The difference between the US-USSR conflict and the US-China conflict is that US and USSR were unconnected subsets, whereas US and China are completely entangled sets.
Exactly.
And therefore messy. So what may be the end game? Will it be just that a part of the Chinese production comes back to the US, or reality changes just a bit, or will it be very drastic? What does the end game look like at this juncture?
I think it's difficult to say. I mean, clearly, the tensions between the two have been rising for some time, and one of the very few issues on which there is a bipartisan consensus in Washington is that China is now this strategic rival to the United States, and I think they've realized that there are economic vulnerabilities. I chaired a panel for the G7 countries back in 2021 where we looked at exactly this question of economic resilience, and we realized that point you made about the Chinese monopoly in the production and refining of critical raw materials was and is and remains a vulnerability. They've invested in it, the rest of us haven't. And we need to create much more diversification if globalization is going to continue. So there are some scenarios in which things deteriorate very sharply, particularly if there were a crisis around Taiwan, for example. There are scenarios where they reach a new equilibrium, where essentially their economies disentangle in some of the high-tech, defense, most sensitive areas, but the bulk trade continues, and that happens in a sort of normal and evolutionary way, where some of that production moves to India or to Vietnam or other countries, some of that production continues. And I think what's in everyone's interests, India's interests, Britain's interests, and actually America and Chinese interests, is that they manage their way through this so that there is a flaw to the deterioration in their relationship, but it doesn't get out of hand.
That seems to be the best case that you are drawing up. Okay, what's the worst case? Before you come to the worst case, in your scenario, is a Chinese attack on Taiwan or even usurping Taiwan a possibility?
It's clearly a possibility in that the president of China, President Xi Jinping, has told his forces to be ready for military action in Taiwan by the end of this decade. That doesn't mean it will happen, but clearly they have that in mind, and they've always threatened military action were Taiwan to declare full independence from China. So that remains a risk and clearly remains the point of tension that is most dangerous between the United States and China, because it's the one that could bring them into direct confrontation with each other. One of the things I take some heart from is that despite all of the tensions and conflicts around the world, the US and China haven't really come into direct confrontation with each other so far, and both governments seem determined to try to avoid that happening. They have a highly competitive, highly rivalrous relationship, but neither wants it to get out of hand. So there are clearly risks that it could. Taiwan is probably the most acute risk, but notwithstanding the pressures, notwithstanding the punitive tariffs that the Trump administration has imposed, there remains a relationship, and they remain determined to avoid that relationship deteriorating to the point of confrontation.
Well, I'm going to ask you a directly economics question.
Please.
Do you expect that there is going to be disinflation because a lot of Asian countries will have, slack extra output, and which they will try to, push around within Asia, therefore disinflation? Or can it be inflationary because everyone erects barriers against Chinese goods, or because of supply chain dislocations? What's the more likely scenario?
I think inflation is the more likely scenario globally. But of course, the point you make is there could be pockets of disinflation, or actually quite big zones of disinflation for the reasons you say, as supply is diverted. But the inflationary pressures are quite strong. First, as we learned during COVID, completely globalized supply chains can create monopolies. By the way, the one we've talked about of critical raw materials is not the only one. There are other monopolies in other parts of the supply chains, including in some quite everyday goods. And as countries seek to create greater economic resilience, onshore, reshore, nearshore, etc., that inevitably, and optimized for resilience, not just cost, that creates an inflationary pressure. Tariffs and protectionism create an inflationary pressure, and we appear to be moving into a protectionist period between the United States and the EU as much as between the United States and China. And of course, the same goes for the US-India relationship. So that's inflationary as well. And big deficits are also inflationary because they drive up inflation and thus interest rates. And so the factors, the up arrows, if you like, overall, I think outweigh the down arrows, and that we are probably in a period of structurally higher inflation than we have been really since the financial crisis. But of course, there may be zones of the world, there may be countries where the numbers go in the other direction.
I don't think central bankers are prepared for this. At least in Asia, we are talking more about disinflation. This can be a nasty surprise. Exactly. Let me come to the other part of the global theater where there's war. The US, the Russian-Ukrainian conflict. We don't have time to discuss a lot of the intricate questions, but how may the end game be? Will it be like the old Poland and Hungary, which were like kind of colonies of, with only friendly governments of the old USSR? Or will it be like Afghanistan, where the armed conflict goes on and then, Russia retreats at some point? How is this ending?
Well, very difficult to say how it will end, but I think in the immediate future, it seems now that the impetus to try to stop the fighting, create a ceasefire, and then some kind of an arrangement around that, details highly controversial and still being hammered out, that feels as though that is the likely next phase. The truth is the war itself is pretty much at a stalemate, and neither the Russians have been able to make much territorial progress, and the Ukrainians haven't been able to expel them from from their territory. And so some kind of ceasefire deal looks likely. That will probably mean the conflict stabilizing along, broadly speaking, the current lines, with Russia in occupation of significant parts of Ukraine. For Ukraine and for certainly Western governments, they will not concede sovereignty, Russian sovereignty over the areas they occupy. They will regard that as occupied land. And of course, we have many other conflicts around the world where there is land that is occupied, sometimes for a very long time, sometimes for many decades, yet the conflict itself has stabilized. Whether that's a ceasefire line, a line of control, a green line, yet to be determined. That seems to be the likely outcome in the immediate future. Okay. And then whether there's a long-term settlement, I think, yet to be determined.
Okay. Well, finally, what about the, I won't call it hegemony, the dominance of the United States and the dollar? You know, logically, if the United States wants a surplus with every country, we won't have enough dollars for dollar as a medium of exchange. Is a little bit of de-dollarization likely?
I think we're seeing some de-dollarization. I don't think there isn't really an alternative reserve currency out there. People sometimes speculated about it, but the renminbi isn't convertible, so that isn't even a possibility. The euro has never really achieved that status. But it does seem likely there'll be some de-dollarization. We're already seeing, for example, some oil now being sold in different currencies to the dollar. And of course, what we've also seen in the past few weeks, since Liberation Day, the day that President Trump imposed, or at least announced, he didn't actually impose, announced all of those tariffs, was the bond market became quite volatile. Yes. Not just the stock market, but the bond market. And of course, that is having an effect on the dollar's status as well. But there isn't really an alternative, I think, in the immediate future. I think a risk for the United States is they may lose some of the benefits of being the reserve currency if essentially some de-dollarization, even at the margin, starts to happen.
Lord Sedwill, thank you very much for sparing time for us in CNBC-TV18.
Thank you so much.
Well, that's the key takeaway. We have not yet understood the dangers of inflation. We are probably going to see more globalization than we are giving it credit. Probably a large part of globalization will be preserved, and we can't do without the dollar. There isn't much de-dollarization. Those are the key takeaways. Thanks so much for watching. It's The Economy. After a break, time for Chartbusters.
हो गया? Shreya, say something. Yeah. Russian is the last segment. We have to make it back for this thing.
Cool, cool.
B Street opens in the green following bullish global cues. Nifty rises above 24,500. The Nifty bank bounces back. Autos and metal stocks lead the gains.
Adani Ports is higher in trade on the back of a strong showing in the fourth quarter numbers. The EBITDA rises 24% from a year ago. The profitability as well jumps up.
Maruti trades more than 3% higher after a good session in the previous trading session as well. April auto sales come in slightly better than estimates. Total sales rise 7% year on year.
Indostar slips only 5% despite a good fourth quarter as the lack of dividend disappoints the street.
Bunch of other stocks in focus. PNB Housing Finance climbs after nearly 1.7 crore shares exchanged in a block deal. Nuvoco Vistas rally 6% after record volumes in the fourth quarter, whereas Go Fashion too surges on the back of strong fourth quarter numbers.
Hello and welcome to Chartbusters. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. And as you could see, shortly we'll have on the top of the screen, yes, we have